Hi everyone, how are we doing? So first of all, thank you for coming. The fact that you're here when it's not a required presentation definitely shows that you're interested in learning and uh, will tend to do better than those folks that really wait until the last minute to take a look at this stuff. So what I'm going to cover for you, my understanding is we have some continuing students and students who are finishing up pretty soon. So we'll start by covering a little bit about budgeting while you're in school using our cost of attendance, and then go into a bit about repayment and how budgeting now can affect you going forward. So just to start off, we like to say having a budget is really just having a plan for your money. It's telling your money where to go instead of wondering where it went at the end of the month. It's best to save as much as you can, especially in times like this, because unexpected emergencies can come up, obviously, and it's nice to have a little stash set aside so those don't become too upsetting financially. So what you're saving for, obviously emergencies like we mentioned, long-term items such as having to replace a car or buy a home, or your loan repayment once you graduate. Short-term things that you'd like to prioritize, clothes, entertainment, travel. And of course, way long-term is retirement once you get started. As soon as you get out there, obviously take advantage of any retirement plans that your employer would have available for you. So where to start? List all of your income, be it any wages you have from working, if family is helping you, if you are using financial aid to cover your expenses while you're attending, that all counts. Once you have that all totaled up, then you list all of your expenses, and those will generally fall into one of two categories. Your fixed expenses, those that are the same every month, things like rent, any insurance premiums you may have, and then variable items like some of your utilities and groceries, entertainment expenses. If you ever have to cut costs anywhere, that's always where you want to start. Then what you do from there, obviously pay your expenses, save as much as you can that's left over. If you have taken out more loans than you need, you can make adjustments throughout the year. So if you found that you've received a refund and don't need all of it, we can always return a portion of that. And if we do that on our end, it would be as if you never took that loan out. Whereas if you were to say, I have an extra $1,000, I'll just pay it towards my loans, any interest that had accrued during that semester will stick. If we make the adjustment on our end for you, they will reverse that interest. So it'll be as if you never took it out. So if you get to the end of the semester and you find you don't need all of a financial aid refund that you may have received, get in touch with us so we can figure out how much, if anything, you want to return and hopefully save you guys some money in the long run. So obviously you're going to want to find a way to track all of this month to month. It'll take a few months to get an idea of what your true expenses are, as they can go up and down throughout the year. So you want to find what is right for you. That's not going to be the right thing for everybody. If you're using a resource and it really isn't right for you, you're obviously not going to use it, and you're not going to get a true idea of what your expenses are. So find something you're comfortable with, be it something through an organization like Mint or your own bank, just tracking things on a Google spreadsheet or an Excel spreadsheet. Whatever works for you is the right way to go. As long as you're being honest with yourself, tracking every expense you make is the only way you're going to know what your true expenses are. And you may be familiar with our cost of attendance. Every school has one. School of Social Work is no different. It's a good idea to use that as a budgeting tool, because that's the type of aid that we can make available to you. We will determine your cost of attendance with the School of Social Work, and it will cover the academic year only. That's important to remember if you are not working during the summer or any semester you take off. We can only award you aid for the time you are enrolled. So standard academic year is going to be 9 months. We can only offer you aid to cover that 9-month period. So that includes any housing expenses you may be covering with your loans. So if you use loans to cover your housing expenses, keep in mind we can only budget for August to May. If you spend all of that and it gets to be May, you may come up where you're short for the summer. We wouldn't be able to make any adjustments if you aren't going to be enrolled over the summer. So what we recommend is if you aren't working during your off time, treat that as a year-long budget, 12-month budget, and just use that to budget accordingly with your indirect expenses. like housing or transportation, personal expenses. Your health insurance, if anyone is using the UB medical insurance, we don't include that in the cost of attendance, but we can make adjustments. So if you are making use of the UB medical insurance, get in touch with one of your financial aid advisors, and we can often increase your budget to account for that additional expense. So this is an example of what your cost of attendance looks like. You can see it varies a little bit depending on your living situation. If you're off campus or on campus, or you're a commuter, your costs will vary based on that. So you'll see the room and board costs. You're not going to have that if you're commuting or living off campus. If you are living off campus, that's when you'll see the living allowance in there. So that top part, the darker blue section, those are your direct costs. Those are things that UB is going to bill you for, like your tuition and fees. The bottom section are your indirect expenses. Those are the things you can play around with a little bit. Those aren't set in stone. Those are just expenses that a student may have while they are attending. So we can include that in your cost of attendance if you need to use financially to cover those expenses. So we touched on this briefly, using your cost of attendance to budget. If you're attending fall and spring, that's a 9-month budget. If you attend over the summer, that's when we can increase your budget to cover those summer expenses. But if you're not, you're going to want to make sure that you use that as a 12-month budget so you don't run out of funds at the end of the year to get you through the summer. And again, if you're over budget, take a look at those variable expenses to see where you can cut costs and save a little. Obviously, buy used books if you can, avoid late fees. Consider if you're paying for things twice. If you have, say, an Amazon Prime and a Netflix and a Hulu, you can, in some cases, cut some of those out. If you're paying for a gym membership and you can use the gym on campus, that's another good place to look. So taking a look at repayment, there are quite a few repayment plans now. There used to just be a standard and a graduated plan. I don't expect anyone to commit this to memory. They all look very similar if you're looking at them side by side. This is just to give you an idea of what you're going to be looking at in the future. There are online repayment calculators. They're a great resource as well. And I'm going to go through the differences and show you how the end payment will change based on each repayment plan. So standard plan was the original plan, and that is where they would take any loan balance you have and just break it up over 10 years. The payments would be even each month. Graduated plan is also on a 10-year repayment term, and then under the graduated plan, they would start your payments low and increase them every 2 years based on the assumption that as you're working, your income will go up. There are an extended fixed and an extended graduated plan. They will extend the repayment term to 25 years and break it up either evenly or, like the graduated plan, start low and increase those payments as you go on. Give me a minute to write that down if you're taking notes. And I'll also send this to your coordinator electronically in case anyone wanted to refer back to it, so you don't drive yourself crazy trying to write all this down. Recently, they've developed quite a few income-driven plans where the amount you pay is based on the amount you earn. For each of these plans, you do have to apply with your servicer. And I didn't include this in there, and I think we'll update it for future presentations. Your servicer is the organization that you will be making your payments to. All of your loans are through the Department of Education, but they contract with certain organizations to handle the repayment of those loans. So when we refer to your servicer, that's who we're talking about. They're just the folks that you would talk to about repayment, specifically applying for any of these income-driven repayment plans if you wanted to take advantage of them. So what you would do is you would apply once a year. Generally, they will request either a copy of your tax return, or if you've just started working and maybe haven't filed yet, a copy of your most recent pay stub, and they'll use that to determine what your payment would be for the next year. So just going through these, there are 2 income-based repayment plans, and that's based on when you initially started borrowing. So for those folks who borrowed prior to July of 2014, the payments are going to be capped at 15% of your discretionary income based on your adjusted gross income and your household size, and that can be up to a 25-year repayment term. This one does require a financial hardship. Not all of them do. So if you are higher earning later on in your career, there are still income-driven plan options for you. Second income-based repayment plan is for folks who first started borrowing after July of 2014. And those payments are capped at 10% of your discretionary income, also based on your adjusted gross income and your family size. And that can be up to a 20-year repayment term. Next plan is the revised pay-as-you-earn, and those payments are capped at 10% of your monthly discretionary income based on your family size and AGI for the household, and that's up to a 25-year repayment term. The pay-as-you-earn plan, payments are capped at 10% of discretionary income based on AGI and household size, and that's up to a 25-year repayment term, and that does require a financial hardship. Income contingent plan, the payments will be the lesser of 20% of your monthly discretionary income or your monthly payment if you were on a 12-year standard plan. And that's up to a 25-year repayment term. That's why I say you don't have to commit any of this to memory, because they all seem very similar. But just taking a look at how you might budget while you're in school and how it might affect your repayment. So this is an example of how some students may budget and take out loans while they're in attendance. That top line is if you are taking out loans just for your direct costs, just for your tuition and your fees. If we do that for 2 years, that total will be $30,854. If you were to take out loans to cover your full cost of attendance, so your tuition and fees and those indirect expenses, for the 2 years, that would be $72,000. And if you were to take out aid to cover your cost of attendance and increase your budget to cover any health insurance costs, that would be $75,806. So it's a pretty big difference there. It can be a potential difference of just under $45,000 in borrowing. And we're going to take a look and see how that could affect you after you finish your repayment. So there are quite a few variables in here, so we had to assume a few things. What we did is we assumed 5.31 interest for the unsub loan and 6.31 interest for the plus loan. Those are the current interest rates. Those can potentially change year to year, so yours may not be the same. This is just looking at graduate borrowing. This isn't making any assumptions about undergraduate borrowing. We're assuming this person is a New York State resident, and we're assuming a $61,590,000 salary. That's just based on the mean salary for 2015 with the Bureau of Labor Statistics for a social worker. We're assuming a single tax filer, household size of 1. So if you take a look at the different repayment plans, it can vary quite a bit. Standard plan, once you pay everything off, you would be paying a total of $39,816 in principal and interest. The graduated plan, that's the one that would start low and then go higher, is $42,153. Extended fixed is $55,741. Extended graduated would be $60,825. And the next two this individual wouldn't qualify for because those are the two that required a partial financial hardship. So in this case, they didn't qualify for that. Revised pay as you earn, you would spend a total of $37,573. And income contingent would be $41,367. And these totals were for the individual who just borrowed for direct costs. If we're taking a look at someone who borrowed that full cost of attendance for the 2 years, $72,000, under the standard plan, they would pay $94,775. Under the graduated plan, they would pay $100,813. Under the extended fix, they would spend $135,689. Under the extended graduated, they would spend $147,807. Under income-based repayment, it would be $101,881. Pay as you earn, $121,629. Revised pay as you earn would be $121,474. And income contingent would be at $98,724. So if we take a look at someone who was borrowing that full cost of attendance and also increase to cover the cost of the health insurance yearly. Their principal balance would be $75,806, and the amounts that she or he would have repaid would be, under the standard plan, $99,895, graduated $106,288, extended fixed $143,196, extended graduated $155,966, income-based repayment would be $109,358, pay as you earn would be $132,379, revised pay as you earn would be $132,217, and income contingent would be $104,072. So if we're taking a look and comparing the student who just borrowed the direct costs, tuition and fees, comparing it to the highest repayment plan when borrowing to cover cost of attendance and health insurance costs, there could be a potential difference in the amount paid of $116,000 touch over. So it's important to think about this as you're entering repayment. There are a few public service loan forgiveness programs that you folks might qualify for. Big one you probably hear about is public service loan forgiveness. This program will forgive anything that hasn't been repaid after 10 years if you are working full-time for a nonprofit organization. Nonprofit organization, for their terms, will be anyone with a 501c3 tax designation. If you were interested in qualifying for this plan, what you'll want to do is, once you start working, get in touch with your HR office, make sure that they are a qualifying employer, find out if they have that IRS designation of the 501c3. And they should be familiar with it, but it is a public document. They would complete the employment certification form, so certifying that you are employed there full-time, and you would send that to Fed Loan Servicing. They are one of the servicers. For public service loan forgiveness, you would have to get under Fed Loan Servicing. It's not an issue to change servicers if you wanted to do so. So if you think there's any chance that you might want to apply for public service loan forgiveness, I would recommend getting in touch with Fed Loan Servicing as soon as you enter repayment. Yes?
Does this have to be like consecutive? So say that you work somewhere for like 4 years, then you decide to switch jobs, but you take like say 2 weeks off in between there?
Yeah, that wouldn't be an issue.
What about if you take like 2 years off?
I don't believe it's an issue. I can double check on that and get back to you folks.
Backtrack too, because like for example, I worked for 4 years in the public sector before I decided to come back to grad school. So like and they were a nonprofit, so like I potentially that would hopefully count, but like I'm not working now, so like I wouldn't be working for 2 years and I don't go back in.
You can go back. It's not required that you do the employment certification form every year. So if someone just realized they've been working in a nonprofit for 7 years, they can always go back. We recommend you do it at least once a year just so they have your information.
Okay.
Yes?
So it says just at the bottom, after making 120 on-time payments, that you have to make that amount of payments before you can apply for forgiveness.
Yes. You can
So
submit the employment certification year to year, but to apply for the actual forgiveness of the remaining funds, that's a separate application you would complete then.
So that's like how many years of payments is that?
That's 10 years. So 10 years of on-time payments. So if you were to default somewhere in there, which hopefully nobody would, that time obviously wouldn't count because you're not making on-time payments at that time. One thing to keep in mind with this, do you have a question?
I didn't know if you knew if the public service loan forgiveness is also combinable with like the other repayment plans. So like if you're on an income-driven plan, you can also still be doing
Yes. Yep. One thing to keep in mind with this is they have not started forgiving loans yet. That's going to start in October of this year. So there is a possibility that once they start forgiving these loans, they'll see that it's more expensive than maybe they anticipated, and they could make adjustments to this plan or do away with it completely. So we say go forward and submit your applications as if you're going to apply for this. We say be cautiously optimistic. It's possible it could change or be done away with by the time any loans are forgiven in the future. They've talked about capping the amount that would be forgiven. A number floating around right now is $57,500. That's something to keep in mind as well. Another program you may have heard about is the National Health Service Corps Loan Repayment Program. And this would forgive up to $50,000 in federal loans in exchange for a 2-year work commitment with the National Health Service Corps in what they determine to be an underserved area. And the link up there is the application for this program if you're interested in it. They also have, I believe they have a list of agencies up there as well that are considered to be underserved. So you have an idea of where you may be going. Yes?
Are the approved sites, are they all within the U.S. or are they like abroad or?
My understanding is they're all within the U.S.
Okay.
I was looking at this briefly beforehand and they were all U.S. programs. So just a few more resources for you. We recommend you check your credit report annually, especially since you have loans on your account now, just to make sure everything looks familiar. If you ever see anything pop up on there you're not familiar with, always double check. You can follow up with any of the major credit bureaus like Experian, TransUnion. You can also check on your lifetime federal borrowing here at nslds.ed.gov. That is the site that houses all of your federal loans, be it graduate or undergraduate. The only thing not included on here would be any private loans you've taken out. So if you've ever taken out a private loan through, say, Sallie Mae or Wells Fargo, that wouldn't show up on there. And of course, pay all your bills on time. On-time bill payment is going to be 35% of your FICO credit score. Some employers will check that once you start the application process and aim to eliminate or reduce any credit card debt you may be carrying right now. A few budget resources, if you wanted to look into that, there is a resource through SUNY that is called SUNY Smart Track. Link is in there. It's also available on our website. Mint is a free resource. A lot of banks have their own tools available if you have an account with them. And there's quite a few free apps through Android and Apple out there now. And on this last page, we have a link to the federal repayment calculator. That's what I used to get those figures we reviewed earlier. You can plug your own information in there if you want to do it manually. If you wanted to guesstimate how much you may take out by the time you finish up your program, you can also import your specific information directly from that NSLDS website we mentioned earlier. So you can take a look at your exact loan history and see how it might affect your repayment under each of the different plans. And that is what I have for you. I can hang out for a bit if you have any questions. I'm over in Harriman on South Campus. If you don't feel like making the trek, we also have an office here in Porter. And we generally have a financial aid advisor in the Student Response Center every day as well. So you can reach out to any of us if you have any questions about repayment or anything else. Feel free, even after you graduate. It can be a confusing process, so if you want to reach back out to us, that's perfectly fine as well. Any other questions? All right, well, have a great afternoon, everybody.